The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is our senior Chanticleer columnist at the AFR, Tony Boyd. Tony, how are you?
Very well, James, and great to be back together again.
Excellent. Well, this week we're going to look at why the energy crisis might be about to get worse. We'll reveal why AGM season has rarely been this important, and we're going to look ahead to next week's big number for Aussie markets. But first, Tony, the big breaking news today across global markets is, of course, US inflation, which we got overnight on Thursday. Now, last month headline inflation for the US came in at 8.3%. The market was hoping for 8.1%, which would have finally shown the Fed starting to gain a bit of traction and its fight against inflation. But what we saw was a number of 8.2%, a little bit hotter than expected. Now, Tony, we saw a stronger than expected labour market number last Friday night as well. We've got inflation now. Are you seeing anything that's going to dissuade the Fed from hiking rates by 0.75% again in a couple of weeks' time?
No, not at all. I mean, I think this higher than expected number is worrying because it tells you the Fed has a lot more work to do and it's going to keep lifting rates aggressively through to the end of the year. And that can't be good for the share market. Now, James, you've been watching this closely. What's your reaction to the big number?
I think you're absolutely right, Tony. We've all but guaranteed that the Fed is going to hike rates by 0.75% when it meets next November. And that's going to take the official interest rate in America up to between 3.75% and 4%. They use a range over there rather than a single figure like the RBA does. Now, what's interesting, though, is where the market thinks rates are going to top out. What's the terminal rate, as it's called? Before the inflation numbers, they were thinking 4.6%, 4.7%. Now they're thinking 4.85%, which is a really large move upwards. And there's a lot of economists now thinking that the Fed is going to have to take rates to 5%. 5% is going to mean some serious pain for the US economy. I think we're going into a recession now, probably sometime in the middle of next year. Whether it's a deep recession or a mild recession is now the question. But you've got to think about what's happening around the world too. The US dollar is going to continue to increase. That's going to put pressure on economies right around the world, and that's going to make a global recession even worse. So there's a lot to watch here. The next inflation number we get in a couple of months, and I think this is going to continue to be the most watched data point on financial markets around the world. But Tony, I just want to come back to domestic matters for a second and just quickly ask you about the Bank of Queensland result, which came out on Wednesday of this week. Now, this was supposed to be a big moment for the bank and its CEO, George Frazis. They took over another bank called ME Bank last year, but you weren't overly impressed with this number, I don't think.
No, look, I concentrated on the takeover that they did of ME Bank and the promises they made at the time. Now, in hindsight, those promises were a great confusopoly. Basically, they said they'd get a certain accretion, but then you had to read the fine print that what they'd done is they'd loaded up all the synergies of about 80 million into the first year's number, when in fact they only got 38 million in synergies. But look, to be honest, the stock was up 10%.
Wow.
I noticed that the Coppo report said this was great because it gave an indication that margins are not being squeezed as badly as people thought. But really, honestly, James, the bottom line is that he was a company that did a 1.35 billion capital raising at 7.35, and until this result came out, the stock was trading below that. So it's, I think they've got a long way to go to prove that the George Frazis transformation is actually working.
Yeah. And Tony, this isn't the only bank merger on foot. Of course, ANZ is trying to buy Suncorp's bank up in Queensland. What does it say to investors about how hard bank merger integrations are? I mean, yes, Bank of Queensland has started the process of extracting these synergies or savings, as you might call them, out of the two banks. But it's going to take a while. Does that tell us anything about Suncorp and ANZ?
Well, I think, yes, that's going to be a massive headache for NZ Bank to try and integrate. In fact, I think they're avoiding it by allowing it to be a standalone entity with no job cuts to get it through the regulators. Interesting from George Frazis was, when I spoke to him, that he's not willing to say whether he opposes the ANZ buying Suncorp, but he does want to say that they offer a differentiated product that no one else has. And I think he's really trying to convince the ACCC that if this one goes through, no other Big Four bank should be able to take over a regional.
Yeah, right. So that's interesting that he's not coming out and opposing it, though. You think he's got a bigger motive at play here?
I think so, yes, but he was quite sort of cautious about saying anything what would be in their submission. He wants to read what the ANZ Bank says first.
Fair enough. We'll wait for that and dissect that when it comes out. Now, Tony, the excitement of this week was that the Chooks were in one place. Tony and I descended on the Fullerton Hotel in Sydney with the great and good of Australia's energy sector for the Australian Financial Review's annual Energy and Climate Summit. And I think the key thread throughout the 2 days at the Fullerton was discussing the progress of Australia's huge energy transition, which in a way boils down to a pretty simple question. We know we need to get coal-fired power out of the system as quickly as possible, but can we build the new system we need, full of renewables and transmission infrastructure to get them to our homes, fast enough to make this exit by 2030? Now, Tony, it was striking, I think. The room was fairly divided between the optimists, who are sort of excited about the fact that now Labor's brought in this 43% emissions reduction target. We're all on the same page. And then the pessimists, who are seeing high prices and reality biting in terms of how hard it's going to be to pull this off.
Yeah, that's right, James. They basically fell into two camps. There's the regulators who think that everything's going to be hunky-dory. Well, not necessarily all easy sailing. And then there was the actual gentailers, the generators of electricity, who are finding themselves trying to balance these two conflicting issues of shutting down and building at the same time. And then, of course, along came Jeff Dimery. Now, you were there for that. What did you think? It sort of exploded, didn't it?
Well, I mean, it was, the summit had been going along pretty nicely, been pretty interesting. But Jeff Dimery, who's the CEO of Alinta Energy, which is owned by private Hong Kong interests, he got up and basically said, the market's broken. Power prices are going to rise by 35%. There's no way we can build all this renewable energy in the next 7 years or so. And he was basically saying, I'm not sure how we get out of this. And what was interesting is that he was up on stage with Frank Calabria, the CEO of Origin Energy, and Mark Collette, the CEO of Energy Australia. And they didn't rush to disagree with him. That they were basically saying, well, the tenor was Jeff said the stuff we were probably a bit afraid to say. And it just changed the entire tone of this summit. It was quite extraordinary. But I think Mark Collette had the good point. The amount of energy infrastructure we've built over the last 2 or 3 decades, we need to build 3 times that amount of infrastructure in the next 7 years. I mean, you don't have to be Einstein to figure out how difficult that's going to be, and just getting the raw materials, getting the people, getting the government approvals. It's clearly going to be very difficult, isn't it, Tony? There's just those practical things.
Yeah, exactly. I mean, I reckon this conference was one of the most impactful and high profile we've had since Mike Cannon-Brookes laid down the challenge to Elon Musk to build a battery in South Australia in 100 days. I mean, yes. We even had the Australian newspaper splashed with the story, and apparently their reporters had attended some small energy conference somewhere in a hotel in Sydney. I think you're right. This challenge of the future is as much about how fast we go, and but also how quickly there can be coordination between the government and business. And so that was why some of the panels were so interesting. I mean, you hosted a few. Who was the most interesting person you spoke to?
Well, I think we had a woman called Phaedra Dackett from Tasgas, a gas retailer in Tasmania and Victoria. She sort of explained, her clients, her customers, one was a big laundry down in Tassie, they're going to see their gas price rise 3 times next year from one year to the next. And, this is an environment of rising interest rates and wage pressures and skill shortages. That's pretty tough for any business to tackle. So I thought that was interesting. You had a great panel with Matt Halliday, the CEO of Ampol Energy, the old Caltex. He's about to buy an EV, but he's not so optimistic about how quickly Australia's going to switch to EVs.
Well, no, I asked him, what's your market cap? And he said 8 billion. And I said, how will all those refining assets and petrol stations, are they ultimately going to go to zero? And can you maintain a large capitalisation in the stock market? And his answer was, look, we'll be pumping petrol well into the 2040s because their forecasts are that only 15% of Australia's vehicles will be EVs by 2030. So that was interesting. Actually, the panellists, Matt reckons he's going to buy a Genesis GV60. Jennifer Westcott on the panel, the Chief Executive of the Business Council of Australia, she's just bought a Volvo XC60, and Tayana O'Donnell from Deloitte has just bought a Tesla 3. Now, the critical thing there is that 2 of those cars cost $65,000 and one cost $100,000. These prices are going to have to come down by, to at least 20 grand before we really get the mass market adoption out there. Don't you agree?
Yeah, it's going to have to be serious price falls. I mean, to be fair, we have seen that in, say, solar energy, that prices are high for a long time, then they can fall very quickly. And every car company in the world's got big plans in this area, so it could happen. Tony, let me ask you the sort of tough question at the end of the couple of days. Do you think, after what you've seen, can we hit 43% emission reduction by 2030?
Well, James, I think we can. And I say that because I think Chris Bowen is going to introduce the appropriate level of emission reduction standards on motor vehicles. And, of course, the transport sector accounts for about 20% of all carbon produced. Of course, Bowen's problem is that he's got a consultation paper out there, but his problem is that the Greens and David Pocock in the Senate don't think a plug-in hybrid is an electric vehicle. They reckon it's a fossil fuel vehicle. So the definition that Bowen has of EVs is including plug-in of hybrids. So that's a bit of a fight that's got to happen. But if coming out of the other side of that is very tough emissions standards, then all of the world's global car makers will stop dumping their internal combustion engine vehicles here and really be highly motivated to sell as many electric vehicles as possible.
Yeah. Look, I'm the other way, Tony. I sort of started the summit with optimism, and then I just sort of got a bit overwhelmed by the practical challenges here. I think the industry is completely aligned and they're going as fast as they can. But I had a panel with a company called Arc Energy, and they're looking to install a battery up at their zinc refinery up in Townsville. To get this thing approved, even if they hit the go button now, it wouldn't be in and operating until 2025. So that's a great example. That's one battery in one factory in one city. Now, to do this across the country, we're just not going quick enough. So some big things have got to change, and I think that 2030 target, unfortunately, is going to be very, very difficult to meet. But I was impressed and I guess heartened by the drive of everyone in the industry. So let's hope that the pace can pick up when we have our summit next year. We'll see a big
And will we
change.
invite the Australian or?
Absolutely. We're a broad church here, Tony, of course. If you want to know what some of the experts think about our ability to reach net zero by 2030 or 2050, do yourself a favour and tune into the Tech Zero podcast from the Financial Review. Host Peter Kerr asks all the entrepreneurs and experts he profiles about their predictions for 2050, and you'll find some great content about the chase for net zero on that podcast. Now, Tony, the other big event that kicked off this week is AGM season. Now, when I started in journalism just over 20 years ago, the annual general meeting, which is a listed company as on the stock exchange, needs to have one of these every year. it was really sort of on its last legs. Every year you'd see stories about whether AGMs were actually needed. But the advent of compulsory votes on the pay reports that a company's got to put out, and the fact that if those votes were negative, we could end up with a situation where the board was under fire. That's really livened up these AGMs, and they're really important. This year they're going to take on an extra dimension though, Tony, because most companies at an AGM will give out a trading update, and they will say a little bit about how the last, the first period of the year since June 30 has been travelling. We didn't get a lot of visibility at the August reporting season about how companies were travelling, so everybody's looking to these little earnings updates during the AGMs to figure out how companies are going. We've had a couple of AGMs so far. One of them was Baby Bunting, which revealed that its margins are under pressure, partly because of the falling Australian dollar, partly because of inventory issues. Is this something we're going to see repeated, Tony, where we start to get a bit of a reality check from how companies are starting to struggle as interest rates rise and the dollar falls?
Yeah, I think we are. I mean, the AGM season is not usually the profit downgrade season, but it could be this year. I mean, you can't have an AGM, of course, unless you got an annual report and a notice of meeting. Well, the one that struck out to me was Dubber, which is a transcription software company. Yes. It's a global company. It's done well out of Melbourne, but it failed to deliver its annual report within the timeframes laid down by the ASX, and they were suspended from trading. They came back on Monday, and behold, a quarter of the company's market cap disappeared. Now, it managed to publish the annual report, but that showed a $10 million drop in revenue, so they had to restate that. And then there was an $8 million sort of bad debt that had to be recorded. Yes, look, I mean, right. You've got to admire the company in some way. They were basically forced by their auditors to adopt accounting standard AASB 15, which says, I like this standard because it says that you can only book cash sales and not contracted sales. So I think a company that runs on cash is probably better than one that runs on hope.
Yep.
So that sounds pretty reasonable.
Well said. Well, the other thing, Tony, we're going to see a few more of during this AGM season is these say on climate votes. Now, they borrow a little bit from the votes on pay reports. Basically, companies are required to put their climate transition plan to a vote, and that means they put out lots of detail around the plan, what they're going to do, how it's going to work, what the scenarios are, and they have these voluntary and non-binding votes, so there's not a whole lot of accountability about these votes. But I think it could be an interesting part of AGM season going forward because there's so much attention from investors about how these climate action plans are actually tracking, isn't there?
Yeah, there is. I mean, it really focuses the minds of directors on the issue. And I think these days this is a really key topic for the risk committees of all of our Australian companies, because not only is it a way of managing the risks of climate affecting a company, it's also a way of attracting potentially new ESG-focused investors. So I think say on climate is a positive development, and companies should do what they can to embrace it.
Yeah, man, I think what's been particularly good is that we've seen the big emitters, the big power companies, the big miners, that they really have embraced it, and the level of details vastly improved. And not all investors are going to agree with the path these companies are taking, but at least let's see the data, let's see the detail, and we can all make an informed judgment, which is good. Tony, speaking of climate issues at AGMs, the other good thing is that we're back in person at AGM. So, well, it's good and it's bad. Commonwealth Bank had their AGM on Wednesday, and we saw something quite unusual as they came back into the room at the MCG, actually.
Yes, there was a whole lot of environmental protesters who started singing and disrupting the meeting, and Paul O'Malley was struck silent, and Matt Common was sort of trying to advise him, sitting there with an unusual look on his face. So, yeah, I mean, there's advantages of being together face-to-face, but of course the CBA chose to not have any questions from those coming online. Yeah. Now, Telstra had their annual meeting this week as well, and they had what's called the hybrid meeting, where you could come in from Zoom or whatever other video connection and actually get to ask questions. So I reckon that's not a bad format. That I can't see why the CBA couldn't afford to do that. After all, why should I travel to Melbourne to go and ask a question of the chairman?
Yeah, well, and that question was asked of the CBA board, that there were, I thought, there were lots of shareholders clearly excited to sort of be back in front of the directors and have their chance to ask a question. But there was also clearly a lot of shareholders, as you say, who couldn't travel to Melbourne for one reason or other. Cost obviously is one, but some elderly people might not be able to make the journey for health reasons. There's people with disabilities. So I'm with you. I mean, let's go the hybrid model. We don't want all virtual, but we don't want all of these meetings to be in person. We're smart enough to use technology now, so let's do it. Now, Tony, what are the sort of key things you're looking to learn about the health of the corporate sector out of the AGM season?
Well, I always go straight to the chairman and the CEO's speeches, listen for any updates that may come through, intensive questioning. But yeah, you're trying to take the pulse of the economy through these large corporations, and let's hope there's not too many downgrades over the next month.
Yeah, I think the thing to look for is any reports about margins. So margins have been very strong over the last couple of years. They should be coming down right now as demand falls off and inflation rises. So let's look out for that very closely. What's happening with profit margins and what's going to happen over the next 12 months. Well, Tony, we're going to come back after the break and we're going to look at the big number that's set to shape markets next week. All right, Tony, well, welcome back. Next Thursday is a big moment for the Australian economy, for the Reserve Bank, for the market. That's when we get unemployment data. Now, currently we're sitting at 3.5%, but I noticed today there's actually some predictions it could get down to 3.4%. That's exactly what the RBA doesn't really want right now.
Yeah, that's right. I tend to agree with that recent analysis by Joe Masters at Barrenjoey that we're about as low as you can go on this. Yeah. I mean, 3.5, 3.4, it's sort of like the floor for unemployment in Australia. And it's hard to go much lower because of, supply side constraints and the availability of workers. And so, yeah, we're an incredibly tight labour market, and that I don't think that's going to change much, even if there's another rate hike.
No, well, I think we haven't seen it feed through to wages in a major way yet, but surely that's got to come, doesn't it, Tony? I mean, it's unlikely that we can keep holding wages so low with inflation high and the labour market so tight.
Well, the biggest pay rise I've seen over the last couple of months was Australia Post, where they gave all their workers 6%, which was trying to match the CPI. But, you look at our company, I think the journalists here got a 4% pay rise this year and 3% next year. So that's about the norm. And that, to me, doesn't look like a wage price spiral going on in Australia.
Yeah. It'd be interesting to see as we get through the rest of the year whether we actually do see signs of that. The other big thing in the week ahead is happening tonight, and that's we start to see the big US banks reporting their September quarter results. I think JP Morgan, Morgan Stanley, Bank of America are all a few tonight and a few in the coming days. This is a bit of a bellwether for not just the US economy, Tony, but the global economy.
It is. If they start to report big losses because of marking to market leverage finance loans and taking big provisions for bad debts that they're anticipating to happen because of a recession in America, that's going to be worrying. And of course, I think a lot of people will be looking for indicators about what might happen at Credit Suisse. I don't know whether you saw it, but Goldman Sachs did a report on Credit Suisse, and they reckon that as a result of their restructure, which we've both written about, they're going to need maybe they're going to have $4 to $8 billion Swiss francs hole in their balance sheet. So this brave analyst at Goldman Sachs, Chris Hallam, says they're going to have to raise at least 5 billion Swiss francs, which is a big capital raising, especially where the price of the shares are at the moment.
A lot of pain for long-term shareholders too. So, look, I think the situation at Credit Suisse seems to have stabilised, but, I think you're right. If some of these US banks come out with weak results, that might reverberate onto Credit Suisse because they are one of the weaker banks on the street. So that's something to watch. We've also next week got quarterlies in our own backyard. The miners have their quarterly production reports coming out. The two big ones next week are Rio and BHP. It's an interesting time, isn't it, Tony? We're hearing a lot about the Chinese economy and how it's performing. And I guess these miners' reports give us a little window into what they're seeing.
Yeah. Well, China's property market remains very weak. So, and there's also pandemic-related lockdowns over there. That's bound to have affected their growth and therefore their demand for iron ore. I was reading a note put out by Citigroup talking about the blue sky that's going to be happening in Beijing for the Communist Party Congress coming up. It's once every 5 years, and of course the local media is saying that all of the big steel mills in the province of Hebei have to cut their production by 30 to 50% to make sure the sky is blue for Xi Jinping. And that's probably not unreasonable, being probably the most powerful person in the world. Yes.
Do you have a request in Sydney at the what colour you like the sky of a morning?
Look, it's been grey most of this week, and I think the forecast is going to be grey all through the summer. So, no shutdown of steel mills is going to solve our problems.
Fair enough. Now, Tony, the big sort of question for next week, turn your crystal ball on. It's no good at footy tipping, but where do you think the unemployment rate's going to get to in 12 months' time? I was looking at some forecasts from CBA. They're saying 3.9%. Do you think it'll get to 4%?
Look, it depends really on how hard the RBA goes and the response to that. When it starts getting above 4, it will perhaps have an impact on the banking system because those sorts of things, losses of jobs, which start to cause default rates. But let's hope it doesn't get above 4.
I think the RBA probably needs it to get to 4, just quietly. We had Larry Summers talking, the former US Treasury Secretary, talking on Wednesday about US unemployment, which is also 3.5%. He reckons it needs to get up to 6% before inflation will come down. So I think local Australian unemployment at 4% probably wouldn't be a bad result. But let's see. Well, thank you to also the questions from our audience. We're getting some great questions in, and if you've got one for us, please send it to chanticleer@afr.com and we'll do our best to answer it. This week's question comes from Chris Main, who asks, if inflation's being driven by supply-side issues such as COVID disruptions, Russian sanctions, and the war in Ukraine, how will raising interest rates actually reduce it? Or am I wrong to think that it's mainly supply-driven? What do you reckon, Tony?
It's a great question, isn't it? Because it goes to the heart of, what central banks are trying to do. They're trying to balance that, fighting inflation and not causing serious problems. But I think the Fed is in danger now of causing financial instability. And the IMF this week, you may have seen in their financial stability report, said if there are further adverse shocks, tighter financial conditions may trigger market illiquidity, disorderly sell-offs or distress. And to be honest, James, that's going to be a much bigger problem than paying more for your food in the supermarket.
Yeah, that's true. But I think Chris is right. I mean, these interest rate rises aren't going to fix any of those things, COVID disruptions, Russian sanctions, war in Ukraine or the weather. But the problem for central banks is they really don't have a choice. That they can't do much about the supply side, so they've got to do something about the demand side. They've got to force people to stop spending as much. And so it's one of those, as they say, when you've only got a hammer, everything looks like a nail, and the and the central banks around the world have really only got the hammer of interest rates, so that's the one they've got to wield. So, Chris, you're right. But it is a bit of an issue to watch going forward. How hard will they keep hitting these nails and raising rates? Well, Tony, thank you very much for joining us again. Another big week, and we'll look out for those unemployment numbers next week.
Yeah, James, thanks for joining me too. We'll see you next week.
If you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson and Tony Boyd, and it was produced and edited by Lap Fan and Alex Gow.
The Australian Financial Review.